Welcome to Financial Insider Weekly. I'm your host, Michael Gray, CPA. My guest today is David Beck, a certified financial planner, and his practice focuses on helping families plan for financing college education. He has his own financial planning company, Bay Area Planners. David came to the United States from England in 1982 and worked in product management for electronic component manufacturers, including Tyco. He saw the youth culture at high-tech companies, and he decided that that wasn't the long-term career for him, and so he decided to start a second career in financial planning. David graduated in 2006 from the financial planning program at UC Santa Cruz Extension, and in November 2006, he was trying to help his niece, who was wrestling with financial issues for her college education. He learned that he didn't know as much as he wished about it, and he decided to study in the area and make it an area of focus, and it has developed into his full-time business. And David says that he's found helping people in this area to be very rewarding because he's helping young people get their college educations. So welcome, David. Thank you for being with me here today.
Thank you, Michael.
So today we're going to be talking about families planning for providing for the higher education of their children. This is focusing a little more on higher income families using tax benefits and loans. And I want to caution our viewers that this is just an introduction to the area, and that help is available for further guidance. So in this case, we've got financial planners like David that can help out. There's also CPAs, of course, are available to help out in getting information related to these tax benefits. Before we started this also, we talked about that there is an IRS publication. It's publication 970. You can get it at the IRS website, which is www.irs.gov, and then there's a section there that says Forms and Publications, and you look under Publications and look up Publication 970, or you can also search under Education. I want to caution you that from what I've seen, that at least at this point in January of 2010, it has not been updated for some of the more recent tax law changes. Hopefully something will be coming out soon. So with that, I think we'll go ahead and get started with our questions, David. So why do upper middle class families look to tax benefits in helping related to their financing costs for college education?
Yeah, higher income families have probably looked at financial aid and realized that maybe they'll get some loans, but that's as far as it goes. So now they're looking for other help. Everybody likes to use other people's money if they can, so why not look at the IRS, and instead of sending them $1, we'll take that $1 and spend it on college instead. So we're looking for help in the tax system. We basically want to pay less tax. The government wants to support us in this by offering us some tax breaks, but beyond that, we can look at strategies generally, thinking outside the box, as it were, to try and get our tax bill down.
Okay. So what is the principal federal tax credit that helps with paying education costs?
It's changed just within the last year. It used to be the HOPE credit, but since President Obama came in, we have a new tax credit called the American Opportunity Credit. And it's a much improved credit. So it's the main one. Previously, there were two. There was, as I said, the HOPE credit and the Lifetime Learning Credit. For most people now, they will just go immediately to the American Opportunity Credit. The only problem with the American Opportunity Credit is that it's only for 2009 and 2010. That's so unless it gets extended, we might find ourselves back in that previous situation with the HOPE credit.
Yes. And the amount of the credit, one thing, I guess one of the features of it is that 40% of the credit is actually refundable.
Right. There are a number of good features about the
Yeah.
American Opportunity Credit.
Yeah.
Number one, it's for more money. So the Hope Credit was just $1,900. This is $2,500. And even better than that is the phase-out
Yes.
limit is raised. So it's $160,000 to $180,000, whereas the Hope Credit was $100,000 to $120,000.
Yeah, so a lot of families were seeing that they weren't even eligible for these credits because they were being phased out.
Right. And then, as you mentioned, a tax credit is a dollar-for-dollar reduction in taxes. What happens if you don't pay any taxes? If you're a lower income family and you don't pay taxes, then that credit is normally lost. But this particular one, the American Opportunity Credit, $1,000 of it is refundable. So in other words, even if you didn't pay taxes, you will get $1,000.
Yeah. So
receive $1,000.
So that's a help, especially for these lower income families. And the other thing about this one is that it enables students to get help, although, like you said, it's only available for 2 years, but some may have, for example, used their 2 years up with their Hope Credit. Now they get the additional 2 years that they'll be able to use this particular credit.
Right. The Hope Credit was just for freshman and sophomore year and wasn't for the junior and senior year. But this American Opportunity Credit can be used by juniors and seniors as well. So if perhaps there are some lucky students who got the Hope Credit for 2 years and now will get the American Opportunity Credit for 2 years. So.
Did we want to make any other comments about the Hope Credit, or do you think we said what we need to say related to that? Or?
We don't really know whether, what will happen, as I say, at the end of the American Opportunity Credit. So probably the Hope will come back.
Okay.
And then because the Hope only covers the first 2 years, then you look to the lifetime learning credit.
Right. So let's talk about that
for the last 2 years.
Let's talk about lifetime learning credit. So actually, the other thing about lifetime learning credit is it can actually go beyond the 4-year education.
Mm-hmm. Yes, so it can be used by graduate students.
Yes.
Yeah, but it's a very different credit. It's 20% of a tuition bill, so up to $2,000, which means you need to spend $10,000 on tuition.
Yes.
Not everybody can do that, especially when if you've got a $10,000 tuition bill, maybe you've got some grant money that applies to that. So you take that off first, so that maybe the $10,000 comes to $6,000. So it would be capped, the lifetime learning credit would be capped at 20% of the $6,000.
Yeah.
So $1,200.
Yes. Okay. But the other thing that I think that we were talking about too is that the lifetime learning credit is on a family basis, and where the other is like on a per student basis.
That's right. So if you had 2 students at college and they were receiving Hope credits, each one would get whatever that credit amount is for the family based on the income. However, for the lifetime learning, that $1,200 example I just gave is for the family, or the maximum, the $2,000 is for the family.
Yeah.
So if you've got two students in college, then that doesn't go very far.
Right. What's the above-the-line deduction for tuition and fees?